Hey guys, it's Dr. Steph here, and I just wanted to say after binge watching all 9 episodes of season 1 of Squid Game in 2 days, it got me thinking, wow, this series has a lot of financial lessons on the risks of options and futures trading, debt and gambling, and what a lot of folks may not realize is it teaches you actually a lot about life insurance. So in this lecture, I'll be talking about everything you need to know about life insurance as taught by Squid Game. Now, if you came here to learn about disability insurance, there's actually another lecture for that, which I have linked in the description below. Be sure to check out the pinned comment for the most commonly asked questions that I've been messaged about. Remember, life insurance and disability insurance are different things. Standard life insurance does not pay for your expenses if you become disabled, but disability insurance does. And remember to like and subscribe to be notified of new lecture recordings. Back to the lecture, life insurance. So this lecture will answer 3 questions. Number 1, does your debt die with you? Number 2, how did all this money not get taxed or leave a paper trail? And number 3, what do I need to know about life insurance to make a good decision for myself? So with any lecture I do, I don't have any conflicts of interest to disclose, just to be on the safe side, because I don't know what's considered a spoiler to folks. I'm just going to assume there are spoilers in this lecture, FYI. So the TLDW of Squid Game is basically they take 456 people who are massively in debt, get them to play children's games, and if they lose, they die. But if they win the whole thing, they take home a huge pool of money that increases with each human player death. It was very disturbing but addictive at the same time. So at U of T Med, where I teach, med students have some of the highest debt loads of any profession. It is no wonder they're the ideal target for insurance brokers trying to sell them life insurance. Did you ever see any dentists or lawyers in the Squid Game? No, but there was a doctor. So in this quick video, I'm going to try to use Squid Game as a way to teach one of the boringest lecture topics to teach ever in personal finance. And let's just start by answering the first question. So when you die and you own nothing with no dependents, then your debt would die with you. But if you have assets or possessions that could be passed down, such as an estate, then that estate goes to paying that debt before any of it gets inherited by your beneficiaries. And just as a heads up, key terms in this lecture will be bolded, and often these terms might be used by your insurance broker. Now, the exception to when the debt dies with you rule is if your relatives or dependents are co-signed on the debt. So once you die, your partner, parent, child, co-signer will have to pay it. And this can be tough on them. Can your family live at the same lifestyle with the sudden loss of your earning potential or income? And let's not forget, unless you want to be buried raw, there are funeral expenses as well. A nice coffin is expensive. So other than the debt being passed on and the loss of family income, these immediate expenses of debt are the third reason why someone might get life insurance to cover those expenses. Now, if you don't have dependents or debt, you might be marketed life insurance, but don't get persuaded by the sales tactics because you probably don't need it. Now, to answer my second question, how did all this money not get taxed? Well, after all, for game show and lottery winnings, usually the tax man will take from the pot first before you. But life insurance, that's different. Life insurance is a contract you sign with an insurance company. And when you sign the contract, you're known as the policy holder. And when the life insurance is over or you die, you can get paid a lump sum of money called a death benefit. And that goes to the beneficiary when you die. And the important thing is life insurance payouts are not taxed. So you get the full amount of the coverage you're paid. Now, you might be wondering, okay, actually, I was wondering, where was all of that untaxed money coming from? So, maybe it might be coming from the insurance payouts of all the people who died. After all, death for any reason except suicide triggers the payment from day one. And if the death was by suicide, that triggers payment 2 years of the policy being in force. Now, the other possibility is that it could also be some sort of inheritance, but that's my theory. After all, we've never seen who 𝗬𝗀's father was. So remember earlier, I said the 3 main reasons why someone gets life insurance. Well, the 4th reason applies to wealthy individuals. It can be used as a tool for estate planning by leaving their children an untaxed inheritance. Now, this whole show, it's about betting. And for life insurance companies, they make a bet on your life. Even though they say they help you have peace of mind, they win if you live and they lose money if you die. But for you, I wouldn't exactly consider dying a win. So to hedge their bets, the insurance company will go through an underwriting process. And underwriting is basically determining if a person is eligible for an insurance product and how much risk the company is taking by offering this person an insurance policy. And usually this is done by requesting blood work or physical at your doctor's office. So for the insurance company, it's actually better to offer insurance to young people because they are more likely to live and decline old or sick people. That sounds backwards, right? Those who need it the most are less likely to get insured because it wouldn't be as profitable for the insurance company. And the cheapest time to get insurance is actually when you're young and healthy. So for the old guy, it kind of makes you wonder if he's there for some, alternative reason. So now this part, the terminology of life insurance is probably the most confusing part for most people. So I'm going to try to break it down for you. Now, there are 2 main types of life insurance: term, so think T for temporary, and permanent. Generally, term life insurance is cheaper, about 10 to $20 per month, depending on your age, for your premiums. And this is kind of like a subscription fee. And it's cheaper when you're young. Term life insurance offers a certain amount of insurance for terms. So the terms might be 10 years long, 20 years long, all the way up to 40 years. And sometimes you can increase the terms in 5 to 10-year increments. So for example, let's say if you have a 20-year mortgage, people might get a 20-year term to protect, their family from having to pay off that mortgage once they pass away. So if you die before your term is up, then the beneficiaries get the death benefit. But if the term is up and you're still living, then your beneficiaries or dependents get nothing while the insurance company keeps all the premiums you've paid. So at the end of the term, you can actually renew your insurance, but the cost of premiums get higher the older you get. So as you can see in this chart, right, as with each age increase or each renewal you do, there's like a big step up in the cost of the premiums. So when it comes to permanent life insurance, as the name suggests, it is a lifelong coverage. And the beneficiary or dependent is kind of bound to have a guaranteed payout. And because of that guarantee, it actually has a higher premium. So it's approximately 10 times that of term. And it comes in 2 forms. So it comes in whole life and universal. Now, remember how I said that the premiums are kind of 10 times higher, but they are locked in? So why is that? Well, insurance companies, their goal is to make money, even though they try to sell you on the peace of mind sort of thing. So in order for it to make it worth it for them, they might make you pay a higher premium upfront, but this premium kind of stays the same until you die. And taking the money that you overpaid upfront, companies will invest it pretty conservatively, like in this portfolio that I screenshotted from a life insurance handout, or this one, such that by the time your beneficiary's payout is due, the life insurance company would have made enough to pay your beneficiary as well as themselves as well. So through this strategy, this actually has made the insurance company a lot of money, more than enough to produce that guaranteed payout. So to kind of further entice potential customers, they created under whole life something called participating, also known as par life whole life insurance, as well as non-participating. Now, participating, it's basically when it's when policyholders participate in the performance of the invested premiums. Because remember, when it comes to whole life insurance, the premiums will go towards a cash value, which goes into your guaranteed payout, but also an investment portfolio that can grow over time. And these investment portfolios tend to be low risk or moderate growth. So that is what's often sheltered from taxes. Now, if your participating life insurance investments were to do badly, you actually wouldn't really be affected as much. You wouldn't have to be responsible for making up the losses. However, the dividends that you might get from the life insurance might be reduced a little bit. When it comes to non-participating life insurance, these tend to have a lower fixed premiums, but you don't really receive any of the profits the insurance company makes from investing your premiums. When it comes to universal life insurance, I'm not too sure why they named it universal rather than, I don't know, flexible life insurance, because it has an investment component that allows you to choose what to invest in, and whether it does poorly or not, then you are responsible for the consequences. They don't have any locked in regular premiums like whole life does. They have a flexible premium contribution. And they also have lower premiums than whole life. And usually this can also be used as tax sheltered room once you've maxed out your TFSA or RSP, especially for wealthy individuals. But remember, even though it's called an investment, probably a tax deferral vehicle would be a better term. And remember, tax efficiency, it's not exactly the same as maximizing wealth. Some folks are really focused on minimizing paying tax that they miss the forest for the trees. And they forget that if you want to make money, you got to pay tax. So I usually say universal life insurance, or life insurance for that matter, isn't exactly considered an investment just due to the cost, like the high cost of premiums, admin fees that goes into it. Now, a lot of people might wonder, how much coverage of life insurance should I get? The general rule is about 7 to 10 times your annual salary, and premiums should be no more than 10% of your income. But, given that there are so many factors to take into account when calculating how much insurance you need, I actually suggest going on Google, looking up life insurance calculators in Canada as a convenient way to make a more personalized calculation, because there are many more factors than those generalized ones in deciding, what your debt level is going to look like, how much income loss might your family be facing should you pass away. Now, that was a lot of info, so I'm just going to try to tie it together with a concrete example. And this is actually a scan of a quote that I got from an insurance broker. And often when you see these and when insurance brokers present these to you, it can be really confusing because there's all these numbers and terminology. So I'm going to try to break it down for you to understand, to try to better understand it. And, what are some reasons on why I didn't end up getting life insurance for myself. So looking at the top of the page, you see the name, non-smoker age, and then you also see MTR, which stands for marginal tax rate. On the other side of the page, you'll see that this is a whole life insurance policy that was sold to me. And it also has 20 pay. So that means that the policy itself would be paid off in 20 years. You also see something called paid up additions, which is basically with any whole life, there's like that investment component, right? So the dividends from the investments, any of the dividends used can be used to buy even more whole life insurance. There is your annual premium. So in my case, the annual premium that was given to me was the $44,000 over 20 years, which is approximately $891,000 paid in order to get a $2.5 million of life insurance coverage. And there's also something called an accelerator deposit option, which allows you to make additional payments above the required premium if you have extra funds available for that year. So now on to the next page, you will kind of see this chart. And this is what often gets people confused because insurance brokers show people this and it's like, wow, look at all these big numbers. And it can often be used as a persuasion technique. So on one side, you have something called guaranteed values. And under the guaranteed values, there's something called a cash value. So the cash value is basically like a savings account, and that can earn interest. It can be withdrawn or used as collateral for something called a policy loan. So it's like a loan against your insurance policy that allows you to actually use your life insurance while you are still living. However, just keep in mind that the interest rates for this can be a bit high. Now, the other way of getting out your life insurance while you're still living is something called surrendering life insurance. So, if you cancel the life insurance policy, that can also release the cash value of the insurance. On the other side, you have the cash premiums in the non-guaranteed value side, and it's non-guaranteed because with investments, it can go up and down. So the investment component of the whole life insurance can fluctuate, right? And so that's why they say that those values are not guaranteed based on the performance of the investment. And so in this particular case, the insurance broker actually included the accelerator portion, which is that 15,000 or so portion on top of the annual premium, assuming that I decide to top up my insurance every year. So non-guaranteed value, as I mentioned before. Now, like I said before, the market can go up and down. So in order to account for this, they have this -1% and -2%, which kind of shows the worst case scenario where they would have to decrease the dividends. And also, if you're wondering why this particular number is so high, it's because it actually includes that death benefit, which is the 2.5 million, which is already guaranteed as well. So I've already talked about, why someone might get life insurance in the beginning of this lecture. So now I'm just going to talk through quickly why I didn't get life insurance, because maybe some of these points might actually apply to your own decision making. Now, the biggest reason is why I didn't get life insurance is simply because I don't have dependents. If I die, my debt dies. The second reason is actually my own personal beliefs. For myself, I would rather see the benefits of my financial support of my potential dependents while I'm still alive than when I'm dead. And my middle-aged children will have to be figuring out, what to do with 10+ millions at an age where, they're hopefully more financially stable and are less in need of that money than if they were in their 20s. The third reason is I don't really see a use for taking out one of those policy loans when there are other sources of borrowing at better rates. So, when you look at in more detail what some of these loan interest rates might be, as I said, they can be pretty high. At the time, I also wasn't incorporated. And if I were to have bought life insurance, it would have been with post-tax dollars that would have been at a tax at a higher rate compared to the 12.2% tax that my corp would have paid. And finally, it's the opportunity cost. Like, would anybody in their 20s or 30s be investing in, mostly bonds and other fixed income investments? Not usually at that age. So I thought, what if I had put it in a total market index instead? So let's delve into this a little bit more about the opportunity cost, because what else could I have done with that 890K of premiums? Or let's say if I used the accelerator option, the 1.2 million. As soon as I would have made that first annual premium payment, I would have kind of been stuck because of the sunk cost fallacy, which is an economic principle that states, once you put time or effort into an endeavor, even if it is a bad decision, you will continue to sink time and money into it because you've kind of already committed too much, when the logical solution is actually to leave instead of diving deeper into this. So by the first year, had I paid into it, I actually wouldn't have been able to take anything out of it. So I actually would have had to keep paying until probably even, I don't know, like over 50 years old in order to just break even of how much I already paid. So if I had left in year 5 of the policy, I wouldn't have gotten anything, but I would have lost a lot of money. And then let's say if I did commit 20 years and I actually ended up with a cash value of the $1.9 million, when you actually plug these annual premiums that you pay towards insurance and put it towards a total market fund, and you put it into a calculator with an average rate of return of 7% year over year, even after tax, the total returns would still have been higher. So just some key points. The lesson of all this is that, life insurance is called life insurance. It's not called life investment. It does insure your life pretty well, but the investment component of it often has high fees and it's placed in low growth or stable fixed income investments. Make sure that you want to max your TFSA RRSP first before putting all your money in life insurance. And if you are considering a life insurance product, consider getting term life insurance because it actually insures you for life, not trying to do all these other things that it's not. And remember, when you're speaking to an insurance broker, try to talk to an independent financial advisor first, just because sometimes these high commissions can incentivize brokers to try to sell you whole life insurance. So in this example here, the total commission after bonuses, it's pretty much like 120% of the premiums that you'd be paying. Where did all this time go? So somehow I managed to start talking about, Squid Game, but ended up making you listen to a lecture on life insurance. Now, if you have any questions or you want to speculate on shows, not stocks, anytime with me, send me a message or leave me a comment down below on which Netflix show I should binge next. And as always, thank you for listening.